What's up guys? So welcome to the channel. So in this video we're going to talk about how to invest in the stock market for beginners. In this video I'm basically going to give you guys a step-by-step blueprint on how you guys can invest like your first $1,000 in the stock market. If you're completely new to investing in stocks or you've heard about them and you've been curious on exactly what to do when it comes to investing in the stock market, then this is a video you definitely want to check out, guys. Before I get into the video, guys, I want to remind you guys to smash the like button and give this channel a subscribe if you find this content very helpful, guys. So first of all, let's just talk about like why some of the reasons you would want to invest in the stock market. So a couple of those reasons is simply because, basically when you take your money and you put it in a bank, you're not really earning anything on it. So with interest rates historically at an all-time low, and even in some places like Europe where there's negative interest rates, you're really not earning anything on your money. So what this means is that basically your money is losing value every day. So with fiat currencies, every day they continue to print more and more of them because this is government money that has basically been imposed on the people. That means that your purchasing power is going to continue to decrease over time. So we've seen this ourselves. We've seen everything from the cost of milk, bread, college tuition, cars, houses, you name it. Even Bitcoin, what I talk about a lot on this channel, the cost has been soaring over the years, and that's due to inflation. So why invest in the stock market? Well, the stock market is one of the best ways to hedge against inflation. So you're basically taking your money and you're investing it in these companies that we all use every day. So that's everything from companies like Google, Amazon, Uber, McDonald's, Exxon, Tesla, Coinbase, whatever companies you guys use on a daily basis. You can find a lot of these companies that are publicly traded, and a lot of these companies allow your money to grow. So perhaps you put your money in a stock like McDonald's, or you put your money in a stock like Tesla. You can grow your account basically annually. So some of these stocks might return 10% a year. Sometimes they might do 500 or 600%, even 700%, like Tesla did in 2020. So, this is the secret of the rich. The rich, they usually either own a lot of cryptocurrency, which we talk a lot about on this channel, or they own stocks. So historically, the wealth has been concentrated in stockholders because they basically own portions of companies. So basically what a stock is basically a paper asset. It basically gives you a right to a portion of a real life business. So for example, if you were to buy stock in Amazon, that would give you to a portion of the assets and liabilities for Amazon Inc. And those shares represent a real life portion in a real life business. So for example, if you own Amazon stock, you're going to own some of the same stock that someone like Jeff Bezos owns. So shares are fungible. There's no difference. If I have one share and you have one share, it's worth the same amount. And a lot of these stocks are traded on public stock exchanges. So one of the reasons why people kind of get intimidated by investing in stocks is because they think you have to be super smart, or you have to have a college degree, or you have to have a lot of money, and that's not true. The way things are set up, you can get started investing with as little as just $1. Most of these companies out here, you got brokerages like Webull, Robinhood, Fidelity, E-Trade. They don't have any account minimums. You can start investing with $1, and you don't even need to buy whole shares. So if you wanted to buy a share, for example, of Amazon, it's very expensive. That share might cost $3,000 or more. But with fractional investing, you can actually start investing for as little as $1, guys. So it's really important to understand that stocks are basically small portions of real life businesses, and that it's very, very easy to get started. So how does the stock market work? Well, stocks are basically trades on basically two key factors. So number one is earnings. So every four times a year, so every 3 months, companies will report earnings on how the business is doing. So for example, companies like Amazon, Apple, Google, they will all report to their shareholders, explain how much money the company made, explain how much money the company lost, if there were any losses, and they use specific numbers to talk about how these companies earn their money. So for example, a company will report on revenue. That's how much money the company brought in. And then they will report on EPS, which stands for earnings per share. That is how much money per share that a company has earned. So to calculate an EPS, you would simply take all of the shares of the company, and then you would take all of the profit for the company for that specific quarter or year, and you divide it by the number of shares outstanding. So, for example, if I own 1 share of Apple, and Apple earns, let's say $5 a share, then I'm entitled to $5 worth of earnings for that quarter. And then let's say you have 100 shares of Apple, you simply multiply that by $5 by 100, and then you're entitled to $500 worth of earnings. So this is basically the number one way that stocks are basically moving. They're basically moving on earnings. So you want to try to obviously focus on companies that produce positive earnings, but it doesn't always have to be that way. There's different types of companies. You've got companies that are growing in fast-growing industries like 3D printing stocks. You have EV stocks, electric vehicle stocks. So certain industries are going to be either more mature or less mature, and these companies will either be generating a lot of earnings. So you got mature industries like, for example, McDonald's is going to have good earnings. Apple's going to have good earnings, and then you kind of have newer businesses. You got EV stocks out there and crypto stocks, and these companies are probably going to be growing in the future where they might become profitable. So the second way that stocks trade is they trade on hype. So that's kind of where you're not really investing so much, you're kind of swing trading. So for example, earlier this year you probably knew about GameStop. GameStop, you guys are familiar with the stocks at all, GameStop and AMC. These were meme stocks that were basically trading on hype. So the companies weren't really earning a lot of money, but they were super, super popular. So because the stocks were so popular, people were buying the stock in anticipation of selling it for more money to a different person. So that's kind of the two ways that stocks trade, either on earnings or on hype, guys. So basically, the way I've been investing and the way I've grown my portfolio over time is that I'm looking for two things. So I'm looking for industries that are going to grow, and then I'm looking for the dominant player in that industry. So for example, let's take a look at electric vehicles, right? Who's the dominant player in the United States for electric vehicles? Tesla. So I bought Tesla stock. So if we're looking at electric EV charging stops, that's the charging stations for all of these electric vehicles. Who's the dominant player? ChargePoint. So I bought ChargePoint. If you're interested in investing in restaurants, who's the dominant player in the restaurant business? McDonald's. If you're interested in electronics, who's the dominant stock? Apple. If you're interested in internet search or internet video, Google, which is trading under the parent company Alphabet. If you're interested in the dominant ride-sharing company, Uber. So that's basically my philosophy. I'm looking for the biggest player in the industry, and then I'm going to dig into their quarterly earnings reports and their annual report, and I'm going to take a bigger look at the company. But it's kind of like, if you guys follow sports or anything like that, most of the times when it comes to the NFL or NBA or NHL or any sports, the teams that win the championship are going to have the biggest, strongest, most dominant player in the NBA championship. During the NBA bubble, and they had Anthony Davis and LeBron James, two of the biggest, most dominant players. So, we're going to use that same strategy. And if you take a look at the NFL, people that won the most recent NFL Super Bowl, Antonio Brown and Gronkowski. So that's the same strategy that I'm using in the stock market. I want industries that are going to grow into the future, and then I want the most dominant player. So for me personally, I never put more than, say, 20% of my money in any number one stock. So you'll see other people out here say like 5% or 10%. That's really up to you, basically on your risk tolerance. But me personally, I never put more than 20% of my money into any one stock. And personally, my largest position right now is Tesla, because and the electric vehicle movement and the solar energies and robo-taxis and many things like that. But basically, it's all about finding something that you're comfortable owning, and you want to make sure that you're buying the stock when it's unpopular. So this is so important, and I'm definitely going to probably make some more videos. It's really important to realize, and one of the reasons why a lot of people don't make money in the stock market, you don't want to buy a stock when it's popular. I know that sounds contrary, because most people, they want to buy something that's going up, but the best time to buy a good company is when it's unpopular. So for example, Tesla stock was really unpopular last year, right before the pandemic hit in 2020, and that was a great buying opportunity because the company continued to grow its deliveries, its revenue, but it was unpopular. So what you want to do is you want to buy these companies, buy Apple, Google, Amazon, when they're unpopular, because you're going to get the shares much cheaper. And then you have two things. You can either hold the stock until it gets really popular, and then you can simply sell it for a profit, but then you have to pay capital gains taxes. So here, you're usually taxed at a much higher rate, maybe 20 to 30%. But if you hold the stock for more than a year, you're charged at a much lesser rate of 15%. So my personal strategy is I like to buy stocks when they're unpopular, and then I like to hold them indefinitely. I don't really look to sell them because I don't want to pay taxes. So that way it allows me to have a lot of money, but I don't ever get taxed on any of that money. Selling, you're paying taxes, and you're going to lose like 15, 20, 25%. So for example, if you make like $100,000 in the stock market in 1 year and you've been trading a lot, you're going to lose like, $20,000 to $30,000 in taxes. So for me, I call it strategy. People call it strategy hodling, where you basically hold on to your shares. And then another important thing to do is you really want to take a look at what's going on around you. So what products, services, technologies, apps, especially a lot of apps out here, what are people using? So for example, if you see a lot of people using Facebook, Facebook's an excellent investment opportunity. You see a lot of Tesla vehicles, that's a great one. You're watching this video on YouTube, so Google makes for a great investment. You want to invest in companies where you see people like yourself. Preferably, it would be that you would use the product, but you want to see other people using the product and having a positive experience with it. If other people are having a positive experience with it, that means that there are a lot of other people having the same positive experience. That company is going to attract a lot of customers, going to attract a lot of money, and that stock price is going to go up, probably during the next couple of earnings releases, and that's how you're going to make a lot of money. So that is really, really important key. The product or the company, it has to be useful, and it has to make a transformation into people. Some companies that patient in people's lives, because those types of companies are going to really make you a lot of money in the long run. And then another thing is you want to look at companies that are asset light. So what do I mean by asset light? Well, I mean companies that are asset light are companies that don't need a lot of capital to grow their revenue. So that's companies like Facebook, companies like Amazon, companies like Match, the group that owns the Tinder app, Match, companies like Uber, companies like Google, asset-light companies that don't have to spend a ton of money to make a bunch of money. They use technology to earn money, and that's why you're going to see the FANG stocks like Facebook, Amazon, Google, Netflix. These companies are usually going to have the biggest market caps because they're asset-light. That's so important to find asset-light companies. It's one of the reasons why stocks like Tesla and Google and Amazon do so well, because it doesn't cost a lot of money for these companies to make money. Whereas you look at some legacy companies like, you look at some of the makers like Ford and GM, or you look at some older companies like IBM or AT&T, and people wonder why the stock never goes up. Well, because they have to invest so much money to make money. They're not using technology. They're dinosaur companies. So you want to stay away from dinosaur companies. You want to invest in companies that are asset light. It's very, very important. So then when you buy these companies, all you have to simply do is you just head over to any stock brokerage. Me personally, I use Fidelity and Webull, but there's lots of ones out there. There's E-Trade, M1 Finance, TD Ameritrade. You guys live in Canada. You guys live in Europe where there's Revolt. You guys don't live in any of those places. You can use something like eToro or First Trade, and I'll put some links in the description below. But basically, you want to just there's me personally. I like to just buy every time I get money. So every 2 weeks or every month I get my paycheck, I buy into these positions. I look for the ones that are not popular, and I buy shares, and then I hold. This strategy has been working for me. I've been able to grow my portfolio quite well ever since the pandemic, and I haven't really lost any money. I've made some bad trades here and there, but overall, I'm up quite a bit. Over the last year, my return was around like 30 to 40%, which it outperformed the S&P 500. So I'm pretty happy with this. Of course, I could have made a lot more money, but I'm not all in on stocks. Like, for instance, if I had gone all in on Tesla, I would have been up like 700%. But I'm not the type of person to go all in on any one stock. And a lot of people would say you should go all in on one stock, and I think that's a decent idea as well. So let's say you're scared of stocks. You don't want to actually invest in stocks. Well, another alternative, which I don't personally like, and I'm going to explain why, but another option for you guys is either index funds or ETFs. So ETFs are called exchange traded funds. and they allow you to have like a basket of stocks. So if you bought like an ETF for, say, the renewable energy sector, you'll hold lots of different stocks like Tesla and Sunrun and all these different companies. First Solar. So that's an easier way for some people. Some people, they just buy the Vanguard Total Stock Market ETF. They just own all the stocks. So you own the winners and the losers, and then you get like 10-15% a year. And it's safe and it's conservative, and it can get you towards your financial goals. Index funds are kind of the same thing. You just simply buy into an index fund through Fidelity or Vanguard. I'll definitely link to some of my favorite ones, but I really don't like index funds. And one of the reasons why I don't like investing in ETFs and funds, I like individual stocks, is because I don't want to support some of these companies. So for example, I don't own stocks in companies that produce single-use plastics. So I don't own, I don't own shares in Colgate. I don't own shares in Procter & Gamble. I don't own shares in McDonald's and stuff like that, because they make money by, using plastic. So they use plastic and paper for their products, and then that plastic and paper ends up in the landfills and in the ocean, and then now we have an ocean problem, we have a pollution issue. So me personally, I don't invest in index funds or ETFs for that reason, because I don't want to support companies that have single-use plastics that pollute our environment. Another reason is I don't like to invest in a lot of these index funds and ETFs will have shares in companies like McDonald's and Burger King and Yum Brands and Shake Shack. And I don't invest in companies like this because I don't like holding stocks in companies that sell processed food. I just think it causes too many health problems, and I don't like to support those. But obviously, index funds and ETFs are much easier and much simpler to understand. But me personally, if I were to buy them, I would just focus on technology and software ETFs. So I'm going to link to some of these in the description below, but you're probably going to get better returns, and you're not going to be investing your money in these single-use plastic or these poisonous food companies, that are causing a lot of problems, and they're contributing to, the worldwide obesity problem, which is causing tons and tons of issues. I'm not going to get into this video, but maybe I'll get into it in a different video. So that's just my point of view. I'd say stick to those. If you're going to invest in index funds, ETFs, stick to those technology and software ones, because you're going to get much, much better returns. I'm talking 25, 30, 40% instead of like 10% or 15%. And over time, earning 30% over 10% can make a big difference in your money. So I would say technology and software, ETFs, and index funds over anything else. So then after that, it's just about being consistent. Every time you get money, me personally, I just take a chunk of my paycheck, buy stocks, whatever I need, bills I need to pay. But I always make sure I invest first before I pay my bills. So a lot of people, they will try to pay their bills first, and then they try to invest what's left, and then there's nothing left. So I do the opposite. What I do is I buy my stocks first, and then whatever's left I use to pay my bills. So if I were to get a paycheck, I make sure I put some money in my retirement, put some money in my growth portfolio, put some money in my kids' custodial portfolio, and then whatever's left, I use that to pay the rent and things like that. And it usually always works. I rarely come up short. And if I don't have enough money left, then I just don't spend money for the rest of the month. That's just how it's been. It's been working for me, and I've been watching my portfolio grow. And for you guys that are like don't have a lot of money to invest or coming up with money and always short every month, if you just try that strategy, invest first and then spend less, might work for you. So. And then it's just about being consistent, adding to your portfolio over time, and you're not going to get your best growth. So I would say if you guys are like under 30, under 25, start now. The biggest mistake I did, I started when I was 19. I had a very big portfolio when I was like 22, and then, I started spending a ton of money and being careless with my finances. So, now I'm having to kind of rebuild everything. But it's a lot easier if you start right when you get your first job or your first paycheck, and you just start investing right away, and you don't tap that money. You want that money for the long run, whether you want to retire early or retire at 65. You're going to need your money when you get older, so just make sure you stay consistent, hold on to your money, and keep up with your stocks, and everything should be good. So I hope this video is really helpful, guys. I think this is kind of an introductory step-by-step on how to invest. Basically, take money from your paycheck or wherever you earn money, invest in companies when they're unpopular, keep consistent, and build your position over time, and then you'll be able to hit $1,000, $10,000, $100,000, $1 million, and then multi-million-dollar portfolio. And then depending on your age, the sky's the limit. So that's it for now, guys. Hope you enjoyed this video. Please smash the subscribe button if you enjoyed more videos from me. And that's it until next time, guys. Take care.